What is up, everyone, and welcome to your financial dose. This channel is all about helping you guys reach your financial goal. Today, I'm going to be talking about a topic that is dear to my heart, and that is real estate. And more specifically, can you actually make money investing in condos? And the reason why I picked condos specifically is because A, in this real estate market where prices went up, 2 or 3-fold in the past, depending on where you're living, in the past 10 years, in the past 20 years, it makes real estate much less attainable for the general masses. And condos are one of the cheapest pieces of real estate that you can buy for a personal dwelling on the market. And also, when we talk about condos, a lot of people talk about overbuilt. So if you're looking at the Canadian market, you're looking at Montreal, you're looking at Toronto, you're looking at Vancouver, but especially Montreal, where I am currently living in, for the past 4 years, people have been saying that condos have been overbuilt. But even though people have been saying this consistently, can you make money investing in these so-called overbuilt condos? The best way for us to do this is to look at a few examples that I have that can illustrate what may be a profitable investment and what may not be a profitable investment. Okay, so now I created a sort of mortgage/property calculator that'll help us gauge whether or not an investment in a condo or a given property would be profitable or not. But before we do that, I just want to go over a few things. So obviously, if you're going to be purchasing a property with the intent of renting, we could break down the source of income and the source of expenses that you may have. So obviously, your source of income is the rent that you are going to be collecting every month from your tenant. And then the expenses may vary depending on the country and depending on the type of property that you buy. But for me in Canada, when I buy a condo, I have insurance, I have property and school tax, condo fees, electricity, depending on whether or not you include that in the lease, which I don't, and then the mortgage. And if you want to be more thorough, you can add a vacancy charge. But in my case, since the rental demand is very high, I don't see the point. It just sort of falsifies data, and I don't add it in any other property. So I want to compare apples to apples and not add too many assumptions to the model to then, assume 6 different things that may never happen. So why should we even, it's good to keep in the back of your head, but I don't think we should include it in the model. So the first thing that you may encounter outside of the list that I have here is, well, like I said, the vacancy. You may also have a management fee. You may also have landscaping or snow removal, depending on if the management fee covers that or if you have to pay extra for that. Also, if you're buying like a duplex, a triplex, or an apartment building and you're responsible for the entire building, you should be definitely putting aside some funds to change the roof, replace the windows, and stuff like that, or just simply replacing the carpets that you have in the hallways and in all the common areas, because that falls onto your responsibility. Unlike if you buy a condo, you pay the condo fee and then the property manager does those repairs with the money that they collect every month. Obviously, if the condo fund falls short, you will have to cover the shortfall. So one thing that you hear a lot is NOI, or net operating income, and that's sort of the income measure that is mostly used in real estate. And what that is essentially is it's your rent, and then you take away any sort of vacancy charge or any sort of loss that you would actually incur on collecting the rent. So if one of your tenant doesn't pay you for 1 month, you would actually incur a loss and you would have to decrease your total rent or your gross income before expenses. And then the type of expenses that you can incur would be insurance, property and school tax, condo fees, electricity, if that's included in the lease, but not the mortgage, because the mortgage is a financing charge and we don't include that in the net operating income. So if you have your rent, your gross rent minus all the expenses except for the mortgage, that is what you would find to be your net operating income, or NOI. Another thing that's included in net operating income is depreciation or amortization. And what this is essentially if you buy a building for, $50 million, every year that goes by, the value of that building will decrease on paper, not in real life, but on paper, the way that you would account for it. Because, if you use the stairs, you use the floors, or there's wear and tear on the building. Windows are good for, 30 years. The roof has to be redone every 20 years. So you're going to be eating away at the value of the building from an accounting perspective every, day that goes by. And this depreciation charge will also be deducted from your rent or your net or your gross income to then come down to net operating income. However, I don't really like to include this charge because it's a fictitious charge, and depending on the property that you buy, if it's new, if it's old, you'll have to put in more money or less money depending. So I usually keep depreciation out of it because it's sort of this wild card that yes, you're supposed to say, okay, it expends 3% of the value of the property or 5% of the value of the property every year. But when it comes to actually comparing properties, I don't really see the point in including it. However, when you do file your taxes, your accountant or yourself will actually include a depreciation charge, which will help reduce the amount of income that you need to add to your personal income tax. So obviously it's beneficial from an investor standpoint, but when it comes to analyzing different properties, I don't like adding depreciation because it's an arbitrary value that may or may not realize. It may mimic reality or it may completely not mimic reality, because you can buy a property and not spend a penny on it for 10 years, but incur those depreciation charges every year and then sell it after 10 and make more money because the property value went up. When on paper, the property value went down because the value of the building actually went down. The value of the land, is not affected by depreciation, but the value of the building is. So let's just exclude that and keep it more simple. So now I'm going to walk you guys through my mortgage calculator that I put on the left, and I will post a video showing how I made it. But simply put, we have the property value up here, and then the down payment, which in Canada needs to be 20% for a condo investment. So if the property value is $208,000, the loan is going to be, or the mortgage is going to be $166,400. We make 12 payments per year. Yes, depending on the bank, if you pay bi-weekly or weekly, you will pay off your mortgage sooner because you make slightly more payments under the weekly or bi-weekly schedule. And also you pay a little bit less interest because since you're paying sooner, the principal balance accumulates interest at a lesser rate. So then there are 25 years for the mortgage, and then the payment comes down to $745.66 per month, or $3,750 per year. And here I put an interest rate of 2%, future value of 0, meaning at the end of the 25 years, the value of the loan will be 0. And the total number of payments, which is simply 12 times 25. Okay, sorry, the interest is actually 2.49, but Excel was rounding it down, to 2. So now with these parameters set, and this is actually a real example of a condo that I purchased maybe 3 years ago with a friend because I couldn't get approved for the mortgage alone. And we are charging rent of $1,200 per month. Our insurance is about $257. Property and school tax come out to $21.38. Condo fees about $1,500. Electricity is not included in the lease, therefore I don't pay it, so I put it at 0. And then the mortgage is $745 every month, which comes down to almost $9,000 in the year. And at the end of all these expenses, we come out to $1,555 of profit that we get to put in our pocket. Now, this may seem like a lot, this may not seem like a lot, it depends where you're coming from. But when it comes to condo investing, most people, if you buy a brand new condo from the builder, you will have a very hard time breaking even in terms of cash flow because you obviously pay a premium for new real estate. And depending on the market conditions, if the market's hot, they're going to be priced higher. And since there's so much demand for them, they will sell. But it's not the wisest choice for an investor because yes, you get a brand new construction. Yes, it's fancy. Yes, it'll be very easy to rent. But the rate that you will get in terms of rent will hardly cover the expenses. And most often you'll be running a loss on the property in terms of cash flow every month. And then here at the bottom, I put the amount of principal that will be repaid in the 1 year, and that comes down to $5,200. And the way that you calculate this, or the way that you need to think about this, is every year that you pay the mortgage, part of it goes to principal and part of it is paid in interest, which ends up going in the bank's pocket. And as the time progresses, you will be paying more and more towards principal and less towards interest, because if your balance, like, year one first payment is 166,000, like it is in this example, you're going to be paying 2.49% on 166,000 divided by 12, because there's 12 payments in the year. But 5 years down the road, after paying off, you paid off $30,000, so now your balance or your mortgage is at 136,000. The 2.5% interest on that balance will be less, but your payment remains the same, so more of that money will be sent to the principal. So this sort of principal number will change every payment. Every time you make a payment, you'll have a few extra pennies or dollars, depending on the size of your mortgage, going towards the principal, and in turn ending up in your pocket when you decide to sell the property, or when you choose, or if you choose to refinance it. So now, if we wanted to calculate the total return that we're making, or the way I calculate my return, so cash on cash return, is as follows. So what I'm going to do is I'm going to take my cash flow that I make every month, and then I'm going to take the amount of principal that I accumulate in the property for that year, and we're going to just add those two together. Okay, so that means we're making about $6,700 per year with this condo. And then our down payment is going to be equal to the $41,600. So in simple fashion, we're going to take what we make and we're going to divide it by our initial investment, and that's going to be our return. So we're looking at about 16%. And 16%, again, depending on where you're coming from, if you're a developer and you're putting up these condo towers, you're going to be making, much more than 16%. But if you're a regular person looking for yield, or looking for a place to put their money, well, real estate is a great place, and as this example shows, it is possible to make money in condos, but you need to find the right condo, and we'll get to that in just a second. Okay, so now I will show you another example of a condo that I also bought that isn't so profitable, but there's a reason why I bought the condo. So the value of the condo was $316,000 because it was on the 12th floor. At the end of the video, I'll go through what you want to look for to sort of achieve the most profitable purchase when it comes to buying a condo, and things that you want to avoid. Okay, perfect. So in this example, this is another condo, like I was explaining. It's a 2-bedroom, it's on the 12th floor, and I paid $316,000 for it, and it was a new construction. And as you can see, the return profile is very different. So in rent, currently I'm getting $1,525, which is pretty good for that area. But the expenses come out so that at the end of the year, I'm losing over $2,000, which is about $150 a month. Yeah, again, so the principal, we're looking at about $7,800 that I get to accumulate at the end of the year, for a sort of net benefit, or a total return of $57.51, which would give me a 9% return. Obviously 9% isn't bad, because if you're talking about investing in, the S&P 500, the average return over the past 50 years is, between 7 to 9%. So yeah, we're making 9%. It's not so bad, but every month you're bleeding money. And the only reason why I purchased this property is that there was a deal with the builder that they actually supplied the down payment. So technically, I bought this property for no money down. Yes, there's an arrangement with the builder. When you sell, you need to give them part of the profits. But the point being, even though this property costs me, $150 a month, I'm essentially accumulating money in equity for free, except for the welcome tax, which we have in Canada, which is a tax that when you purchase the property, you need to pay tax on your purchase. The more expensive the property is, the more you have to pay in welcome tax. So, as you guys saw, it's possible to make money investing in condos, but it's also easy to be losing money every month from a cash flow perspective. And to avoid doing that, I'm going to give you a few tips here to help you. So first off, usually in a condo building, the higher the unit, so if it's on the 12th floor versus the 2nd floor, it's going to be more expensive. So you pay a premium for the view, so as you go up in floors, you will pay more money. When it comes to buying a property for an investment purpose, you want to try to maximize the bang for your buck. So there's no sense in buying a unit on the top floor. Yes, you may be able to charge slightly more rent for the unit, but it won't make up for the fact that the unit may cost you $20,000 to $40,000 more, depending on how high, obviously. Like some buildings go up every floor 2 or 3,000. Some may go up every 5,000 per floor, depending on the area. If you're buying in the downtown core, every floor that you go up will cost you more. If you're buying more on the outskirts of a city, they'll charge you a bit less. Second thing that you want to keep in mind is you charge rent per bedroom. And I say this sort of in general terms. Obviously, if you're talking about a 1-bedroom condo that's huge, you can charge more than a tiny 1-bedroom condo. But it will be much more practical for people to have this huge 1-bedroom condo divided in 2 rooms. So you can, have a family live in there instead of just a young professional or a young couple, but, people that only need 1 room. And the idea here is to maximize the amount of rooms but minimize the amount of space. So if you can fit 2 bedrooms in 750 square feet of condo space, you're better off than someone who can fit 2 bedrooms in 900 square feet of space. And the reason why is because when you purchase the condo, you're actually buying it based on square footage. But when you rent it, you can't really charge more if your condo has an extra 50 or 100 square foot. If it is 2 bedrooms, then you charge, around what the rent would be for a 2-bedroom condo, regardless of the small differences in size. The next thing that you want to keep in mind is when you buy brand new constructions, you are paying a premium for it to be new. And this premium, you don't always recuperate it in rent. So my strategy to buy condos that cash flow positively is to buy older buildings. I'm not talking about buildings that were built in the 70s, but buildings that were built, 10 years ago, 12 years ago. The soundproofing is good, the insulation's still good, the windows won't need to be changed, and the building is still relatively new, so you won't see too much work in terms of foundation, in terms of roofing, depending on the quality of the construction, of course. And by purchasing buildings or condos in buildings that are a little bit older, you can skip on the premium that the builder charges on a new construction, and B, since most people prefer living in new constructions, there is a greater demand for them, which is why this sort of condo boom can still occur, is because a lot of people want to buy new constructions. They don't really want to live in an older style condo. So for an investor, it's perfect because there's less demand, so the price is lower, and it's much easier to negotiate with these people or with the sellers of these older condos because there's less people that are interested. And that gives you a very interesting advantage. And finally, the last thing, I know you guys heard it 1,000 times in real estate, but location, location, location. Yes, if you buy a condo in good times, pretty much regardless where it is in the current market, it'll be rented because the demand is very high for rental units and the supply is relatively low. However, in a recession or in bad economic times, when people will be shifting from living, say, in a condo to an apartment building because they are more affordable generally, or they're less high quality in terms of finish, in terms of soundproofing and things like that, even location as well sometimes, people would favor cheaper rentals. And in order for your condo to remain competitive, it's all about the location. If you're close to transit, if you're closer downtown, your condo will be much more likely to be rented than a condo that is further out or in the outskirts of the town. Because in good times, people will sacrifice convenience for luxury or for just getting a unit at all, because some people can't even find a rental unit to live in. And the people that have this problem, well, obviously they're going to pick whatever they can find, and it's great for us landlords. But in harder times, it's all about the location, because you want to be in an area that'll rent out quickly. That way, you don't even have to worry about a good time, bad time. No, you'll have a tenant. Maybe you'll need to lower the rent a little bit, but you'll always have a tenant because of that location. And, actually one more thing to take into account is usually, when you buy a condo, you can also buy a parking spot. But sometimes you can get away with not having a spot if you're really close to transit and if you're in an area where a lot of people would commute downtown. It's not the most convenient thing to drive. Taking the subway or taking the bus is better. So there you can sort of shave off a few $1,000s by not buying a parking spot. But at the same time, you can't charge as high of a rent because obviously if you have a parking spot, you can charge a bit more for that added convenience. Well, thanks for tuning in, guys. I hope you enjoyed the video. I'm not sure if you know, but I actually have a podcast with a friend of mine called Personal Finance Boss, where very similar to this channel, we talk about different personal finance topics in order to try and sort of explain to you what they are. So from line of credits to real estate, like this show, all the way to stock markets, investing, mutual funds and stuff like that. And we try to sort of explain all these concepts in terms that you guys can understand, give you guys examples, and talk about our personal experience with these investment vehicles. Well, again, guys, thanks for watching. Hope you learned something. And if you do appreciate the work that I'm doing, or you feel like you actually did learn something, feel free to subscribe to the channel. That way you'll never miss out on any new video that I post.